Good afternoon, everybody. Today I'm chatting with Peter Marrone from Allied Gold. In today's interview, we discuss the upcoming tariff talk and what it could mean for Canada, as well as what Canada could do to protect its future. We also get into Allied Gold, the recent fourth quarter results, and how Peter plans on turning Allied into a major gold producer. All right, everybody, enjoy the interview. Peter, thanks for joining us.
I'm happy to be here, Steve. Thank you.
So there's a lot going on in the world right now that I think we're all trying to make sense of. You're a guy who's been involved in the precious metal space for years, had a lot of success. I'm sure you're following everything that's happening and making some sense of it, or you've got some thoughts that maybe you can share with us. What's your view right now with the new U.S. administration that's in, what the policies that they're talking about, and do you think it's ultimately going to be bullish or bearish for gold?
Well, I go back to first principles, and I think that independently of if you view the current administration as orderly, chaotic, good for the country, bad for the country, good for the world, bad for the world, I'm sort of agnostic. I look at it from the lens of regardless of what one government or another would do, there are bigger macro issues that are at play that are difficult to change over the course of a short period of time. And those macro issues are very bullish for gold price. Over the course of an administration, you can't change the trajectory that presently exists for the debt and even the deficit in the United States. Many countries are very heavily loaded with debt. At the bottom line here is that we have a debt issue that's occurring in the world, but we have geopolitical instability that is occurring in the world. And when you factor all of these things together, add to that then an inflation component, or at least the risk of inflation, the uncertainty of inflation, I think that's pretty bullish for gold price. If we look at precedents, and I'm not an economist, I prefer to look at historical references. The historical reference of the 70s, I think, does apply here. And if you apply that historical reference point, I think that we're in for some heady times when it comes to gold price. And look, Steve, I said this before, I'll say it again. Gold price has not reached its height. Its height still remains 1980 and $820 per ounce, because in present value, in present dollars, that number winds up to be somewhere in the range of $2,800, $2,900. So I think that we haven't touched that yet, and I think that we will go higher than that.
Now, I know I'm asking you to play macroeconomist, and perhaps that's unfair, but we look at it and we can't help but think what impact these tariff policies would have on the price of gold. In general, the high level overview, if we think about just the near term impacts of the policies that we're hearing here out of Canada and out of the U.S. from the 25% tariffs, basically means, and the Bank of Canada just came out with a statement today that if the tariffs do go in, we're looking at a 6% decline in Canada in GDP, and then there's some rumors that are going around on social media for people who are close to the Liberal government saying that they plan on doing something similar to the pandemic level stimulus if Trump does move forward with the tariffs. Do you think he's going to move forward, and do you think that that's going to be a big impact on gold, or what are your thoughts?
Well, look, so let me parse that out a bit. The threat alone, I think, should be saying to any country, and in this case, as rest about Canada, in Canada, it should be saying we've got to reevaluate what we do and how we do it. I think that we are a country that has we're this catch basin for carbon emissions. We're a comparatively modest emitter of carbon. At best, we represent about 2%, 3% of the carbon emissions in the world. And we have a catch basin in the country because of lakes, water, trees, other vegetation that pretty much absorbs all of that. So I'd look at it and say, if that's the case, and then we're very rich in oil and gas, we're very rich in minerals, we should be exploiting the resources that we have that include water, that include critical metals, rare earths, copper, that include oil and gas, going beyond more broadly to the extractive industries. So we should be encouraging that. We should be lowering trade barriers between the provinces. And I appreciate that that's, easy said and difficult to do, but lowering trade barriers between the provinces. I'm gobsmacked that we're in a country that still does not have a very effective east-west transmission of oil and gas. And so we have countries in other parts of the world that are clamoring for the gas product and the oil product that this country produces. I think that we should be encouraging that sort of investment in the country. Stimulus is great, don't get me wrong. But at the end of the day, I think what we should be doing is we should be encouraging investment and encouraging the entrepreneurial spirit that I think is still alive and well in this country. Thank you very much. So whatever the threat is on tariffs, whether or not they occur, you asked the question, is it likely that they will be imposed? My impression is that this is a gambit leading to a negotiation. I think that this is about what used to be the North America Free Trade Agreement. I think it's a renegotiation of that. Is there a likelihood that the tariffs, at least temporarily, are opposed? The answer is, yeah, there's a likelihood of that. You have to at least assume that that's a possibility, even if not a probability. But at the end of the day, I think what we should be encouraging in this country is economic development, and economic development is across the board. But it has to be emphasized that we should be exploiting our natural resources because we've got plenty of them, and we've got those natural resources that every part of the world, including the United States, clamors for.
So, Peter, you're obviously involved with big projects. You talk to big mining investors, and you have a pretty good sense of where capital's flowing. I was watching an interview with Pierre Poilievre the other day, and he was chatting with CTV News Atlantic, and he went on about a 2-minute sort of uh, I'll say rant about what he plans to do when it comes to mining, and he wants to take Canada from a country that takes 19 years in permitting from discovery to production down to the fastest in Canada. Do you think that that's even possible in this country? Is it possible for the Conservatives to walk in and cut down that much red tape? And do you think that if it did happen, it would create a flurry of capital hopping into our equity markets?
We are a Canada is a small population. It's a big country with vast resources. I don't know if a particular government can do it or should do it, whether or not it's the Conservatives, it's the Liberals, or any other government. But whichever government is in power should do it. I don't think it matters which is the government that's in power, but they should do it. We have these resources. We should exploit these resources. Look, it's not my style to get into politics, but what I would say is, as a statement that I think most people should agree with, is that the role of a government is to make the lives of its citizens better. And so if you've got these resources in a country and exploiting those resources, responsibly exploiting those resources will make the country better, will create economic prosperity, then at the end of the day, we would be foolish not to do that. We have lots of rights in this country, and we should be able to take advantage of all of those rights. But one of the rights that can't be overlooked is the right to feed your family, the right to put food on the table, the right to prosper, the right to send your kids to proper schools, the right to provide for your family. That means that a government's role should be to make sure that there is economic benefit in the country and advancing that economic benefit. Now, look, you've got me to do something that I almost never do, which is to talk about politics. So maybe we stop at that, and then
Well,
move on to something
hey,
else.
I appreciate you doing that. It's just such a special time right now that
Yeah.
we if we don't address the macro, then I'm not sure that we can get into the micro. But let's do that. Let's get into Allied Gold. You guys recently put out your fourth quarter production results. What can you tell us?
Well, we said we would demonstrate that we have a production platform that is in a range of 375 to 400,000 ounces per year. So we produced just shy of 100,000 ounces in the quarter. A mining enterprise is not like flicking a switch and suddenly everything works. I describe it in general parlance as it's sort of like running a town. You don't just flick a switch and everything works. The lights come on, garbage is collected, the movie theater works, everything works. It takes a time and effort to make it work efficiently and then to optimize it to make it work more efficiently. We went public in September of 2023, and it takes a little bit of time to make sure that you start to get it right with block models that are designed better, with mine plans on top of those block models that better reflect what is the optimal way of mining those deposits. So by the fourth quarter last year, we said that we'd be able to demonstrate that the production capacity of these assets is closer to 400,000 ounces per year. We've shown that. And now we're in a position to be able to say that that will parlay itself into what we're doing in 2025 and then in the years to follow. So that's what was important about those results relating to the fourth quarter. The costs have come down, and those costs will continue to come down because the number of units goes up and the cost per unit comes down, but also because of some of the optimizations, that improvements that we're putting in place. We have big cash balances. So it's understandable that people would say, well, how can you fund your growth? Now we're demonstrating that we're generating cash flow, that we're increasing cash balances. We indicated that on a pro forma basis to the end of the year, we were on top of $340 million of cash. So if we look at that plus cash flow, plus the other instruments that are available to us, remember that the Wheaton Precious Metals deal that we announced late last year, there's still $130 million that we have not tapped yet for the development of Kerok. And the best way that I can conclude this part of what we were trying to do is to say that we're advancing what will turn out to be what I think is one of the best precious metals mines, certainly in Africa, and I think, frankly, amongst the better precious metals mines in the world, and that's Kerok in Ethiopia. That's the prize here, because that asset will produce close to 290,000 ounces of gold per year, below $950 all-in sustaining costs. That's an impressive margin to where gold price is and where I think gold price will go. So the result of all of that is that, from this year to next year, the second quarter next year, we'll be increasing production by a full 50%. But our EBITDA and our cash flows, so roughly the bottom line, the cash numbers will be increasing by 3 times to 5 times that number. So 300 to 500%. And that's where you want a mine to be. That's the prize here. And what we're trying to say is we've got the cash balances, we're generating production, we're continuing to generate cash flow. And that puts us in a great position for the development of that mine that I'm describing as the prize.
Now, you spoke a little bit about how you guys have the cash balance for the growth. Is the plan just to focus on the assets that you guys got, or are you guys actively looking at other projects to possibly acquire?
Well, my experience is that you don't just, again, using the analogy of flicking a switch, you don't just flick a switch or because an investment banker comes into your office and says, hey, do I have an idea for you? You don't just immediately after that do a corporate deal. And so, when we talk about what's outside the company, organic growth versus acquisition growth and possible acquisitions, business combinations, you've got to build the relationships with the people that run those companies. You've got to get to know those companies, possibly even under confidentiality agreements, conduct due diligence, and then wait for the moment when it's right for them and for you. At this point, we're sticking to the knitting. We've got organic growth in the company. It is significant. It's disproportionately in favor of cash flow, EBITDA, and the financial numbers. As I described a few minutes ago, that's where you want it to be. So we're focusing on that because that will then deliver the next prize, which is an improvement to the share price. And once your share price has got to a point where you can justify going back to those discussions, to that due diligence, to those opportunities that you've been reviewing, that's what we'll consider what else we can do. But I publicly said, I want this company not to be an 800,000 ounce per year producer. That's the organic growth. And that's over a generation at least, 15, 20 years of mine life based on the assets that we currently have in the inventory of ounces. I want this to be an African champion. I want this to be an emerging markets champion but with a particular focus on Africa. So I'd certainly like to grow the company to something larger than that 800,000 ounces. In the predecessor to Allied with Yamana, we went from 84,000 ounces per year in 2003, and we took it to 1 million ounces per year. I've got a bigger platform, high quality management, impressive opportunities. I think we can do a lot more than 800,000 ounces. I think this is the African champion.
What can you tell us if I'm sitting at home and I'm a retail investor and I like the vision. I like the plan. I'm sure that one of the thoughts that's going to be going through my head is the royalty and tax structure in West Africa. Can you maybe give us a little bit of color on that?
Well, look at it from this point of view. Yes, in many parts of the world, taxes are going higher, royalties are going higher. We started this discussion about the socioeconomic issues, geopolitical issues in a particular country. We talked about the United States, Canada. In Canada, capital gains taxes have gone higher. We've seen over the last decade that income taxes and income tax rates have gone higher. So I think we have to look at it from the point of view of be sanguine about it. Don't fret over what happens with royalties in one country or another. Is it still economical to be able to deliver a project, even if the economics is not as good as it was before? I go back to what I said a few moments ago. I think that there's an economic nationalism that has taken root in many parts of the world. It's our job to manage through that. We're doing a good job in Africa in doing that. Royalties have gone up in some of the jurisdictions in which we operate, but we're still delivering impressive returns on the projects that we have. And we're building rapport and relationship in these countries so that we can more effectively say, how can we make it so that we're producing ounces in this jurisdiction better and we're still able to deliver a quality return. But in the countries in which we're operating, let's look at a country like Mali. 30% of its revenues, the state revenues, come from precious metals mining, taxes, royalties, et cetera. We're a large employer in the country. It would behoove me to see that they would raise royalties to a point where it no longer becomes economic to run a mine in the country. Royalties have been increased. We've looked at it sanguinely and said, even with the increases and negotiated derogation, reductions to those royalties, are we still able to deliver a return? And the answer is yes, we're able to deliver a very high quality return. And look, we're carrying, almost 12 million ounces of proven and probable reserves, 16 million ounces plus of resources. These are generational mines, and we're certainly going to straddle past any of these temporary, shorter-term geopolitical issues and socioeconomic issues.
So the last time we spoke, you closed out the interview by talking about the value of Allied. How would you describe Allied in terms of how you guys trade relative to your peers?
No, that's a great question. So the stock price has improved since we last spoke. Um, Long may that continue. I'm going to attribute that to you guys. And so
Of
I'd like to
course.
do this interview again in a couple of months and just continue the trend. But the stock price has improved since we last spoke. There's still a lot of upside left in the share price. We were trading at about 0.2 times our net asset value, a very low multiple to EBITDA and cash flow, and particularly the growth in that EBITDA and cash flow. Today, we're trading at probably 0.25 times net asset value, and I think that there's a lot more upside to there. Where I think it should be ultimately is at least 1 time net asset value, and there's that upside. And then we're going to be increasing that net asset value. And if I'm right, the gold price goes higher, then the net asset value and the cash flow and the EBITDA will increase as well. And so it's not just the multiple going up, but also the value of the underlying assets that will go up because of metal prices, because of new inventory of ounces and optimizations and improvements to production that will contribute to the bottom line. So look, maybe a summary would be to look at it from this point of view. I'm a recent convert to what happens in the options market and how options in some respects provide a more global view of the possible values of something. And when I look at where we're trading today, the difference to an option is that an option can go to zero, but it has all of that upside. When I look at our share price today, it's almost got only option value, but none of the downside. So you're not going to lose your entire investment in the way that you would with an option, but you get all of that upside. And a lot of that upside is imminent. So it's not just about the improvement to operations going from 343,000 ounces of production in 23 to 400,000 ounces of production in 2025. It's that production increases dramatically next year to 600,000 ounces. And it's because that mine comes into production in Ethiopia. Kerok is a prize. It is a world-class development. It is on one of the more prolific areas for precious metals mining, and at 290,000 ounces per year, with an all-in sustaining cost of below $950 per ounce. When we look at the margins, the cash flow, the EBITDA that gets generated from that operation, it is truly world-class. What's the value of something like that? Well, that's the interesting part, because the value of it today is, I argue, into the billions, and it will actually increase in value once all of that capital is behind us. And now we're roughly 50 months away from that capital being behind us. And we're on track for its development for its production in the second quarter of 2026. We're on schedule and we're on budget.
Well, Peter, thanks very much for hopping on here. I know the last time we had you on, our audience absolutely loved it, and we appreciate you taking the time to do this. I always get really excited when I chat with you because you've got this grand vision, and I think how could an Allied Gold be one of the next big major gold companies in the world, especially the way that you articulate your thesis. So we appreciate you hopping on here, and let's chat in a couple months after the stock's gone up quite a bit, which seems to be the habit every time you guys come on here, and continue to discuss the latest results.
Look, I'm happy to be here, and I look forward to doing this with you again.
All right, everybody, thank you for watching. If you enjoyed this interview, please smash that like button, subscribe, and ring that notification bell. Thanks for watching, everybody.